Welcome back to the Millionaire Choice Show. I'm your host, Tony Bradshaw, and today on the show we have Kelly Hollingsworth. And if you haven't heard the previous episode with Kelly, you need to go back and listen to that. Kelly has done some really amazing things, which we're not going to explore all of those today, but we're going to focus more on investing like a hedge fund manager. But Kelly is helping serious entrepreneurs make serious money. She pushes what we call the gateway to seven, which is developing a seven-figure income, where she helps men and women both develop seven-figure incomes, which is really a huge milestone in the business world and in your personal finance. And she is the host of the new podcast, How to Make More Money podcast. And so if you haven't listened to that, you need to go check it out. Kelly, welcome to the show.
Hi, Tony. So happy to be here again.
Yeah, I'm always delighted when I get to talk to you. You have so much energy and I think passion, and you've accomplished some really amazing things in your life and through your life story, thinking about where you came from, poverty. And I remember, I'm going to steal your story a little bit, but where you used to go across the road, the train tracks, and go clean houses. I think you started doing that at age 13. So that was your first business.
That's right. Cleaning houses for $5 an hour.
$5 an hour. That sounds a lot better than the $3.35 I was getting to clean concrete at the convenience store for my mom and paint curbs. And let's not forget pulling thorn weeds up without gloves on. That wasn't too fun either.
Ooh.
The worst job I've ever had in my entire life. Makes me think about Mike Rowe, Dirty Jobs.
Bill Burr, the comedian, does a stand-up bit where he talks about how people say motherhood is the most difficult job in the world. And he said, well, I don't know. I thought it was being a redheaded roofer in the summertime.
Yeah, I've never done any roofing, but I did carry shingles for my dad where he did the roofing and had to get him up the stairs. So my dad was a carpenter growing up, and I really enjoyed picking up some of his skills. But now we're going to jump into stuff. We're going to do a little bit differently, the show a little differently today, because I really wanted to explore kind of this investing mindset. A lot of the shows that we do are focused on people's stories. And if people want to hear your story, they can go back and listen to that. I really advise that they do that. But I really wanted to talk more about investing because a huge group of Americans, they really don't think of the stock market as being something they have access to. I know my mom and dad didn't really do much with it. They did a little bit through their company 401k. My sister is, in her 40s now, not doing any investing, which I'm sad to say. But I think that's because there's a mindset that we grow up with for, mainstream America that, the stock market is really for the rich people and it's not for the people who are, poor or don't have access to it. And so what do you think about that?
I think that when we think that certain things are for rich people, what we're thinking is that certain things are riskier than what I can afford. What do you think?
Yeah, I think lack of understanding is part of it, right? So if you don't understand something, you tend to shy away from it or be afraid of it, versus, exposing yourself or growing. And I think that's along the lines of what you're saying is being afraid of it, because there's a lack of understanding and knowledge, rather than going and getting the knowledge and becoming more familiar with something and, kind of addressing your fears. People just kind of stay doing the same old things they've always done.
Well, and I also think, so there's, I was at the doctor's office having some blood drawn yesterday, and the woman said to me, I don't even understand. I have a 401k. I don't understand how that's different than a mutual fund. And when I told her that I used to manage a hedge fund, she said, I'm ashamed to admit I don't know what a hedge fund is. And I said, I don't think anyone knows what a hedge fund is. When my grandmother used to tell people what I did, she would say, well, she works in an office across the street from Saks Fifth Avenue. So she didn't understand it either. So I do think there's an element of literacy. There's also fear of risk. And I think there's also not wanting to make a mistake. aside from the idea of financial losses, and I don't quite understand exactly what's going on there, there's the bludgeoning of oneself that you fear you will do if you make a mistake and you lose money. And that feels a little bit different than those two things. It feels related, but a little bit different. Do you agree?
Oh yes, definitely. I think so. I think the fear of failure is something we all face. And when it comes to the stock market, is fear of making a mistake, but fear of failure, fear of loss. And that keeps us from taking action at all, like taking any action.
Right.
And so you obviously had to overcome that. 13 years old, starting a cleaning business, moving into, knowing your story, but getting into hedge fund management. And if I remember correctly, you had a lot of people telling you that you couldn't be a hedge fund manager, didn't you?
Oh, yeah. A lot of people telling me that that was a really bad decision. And this might surprise you, but I am a risk averse person. I do not take risks with money. So I never had fear that I had to overcome. What my thought was, every time I went out to make money, my thought was, it is a certainty that people want this thing that I'm doing. It is a certainty that when I do it, I am going to make money at it. And I always did. So I think the thought, if you want to make some money, you have to take some risks, is actually a big reason that people don't make a lot of money. I remember coaching a man who was struggling in his business, and his wife was about to divorce him because they were losing so much money. And he said, well, you're going to lose money in the first couple of years you're in business, aren't you? And I said, where did you get that idea? He thought he was supposed to be losing money. And so what I'd like to offer is that in investing and in entrepreneurship, if you think you're supposed to be losing money, don't do a thing. Stop and clean that up. Because when I was managing my fund, for example, our first priority was first lose no money. Wealthy people are not in the business of losing money. That's not how you get wealthy.
Yeah, I think that's a great principle. And I think that is a misconception, I think, for business owners. I've always worked for other people throughout my life and done very well working for other people. Now I'm in a world where I'm going, hey, I'm an entrepreneur now. Like, what does it look like to be an entrepreneur? And I
Mm-hmm.
think I've even been guilty of that. Like, the expectation of, oh, it's okay to, be in a loss or be in the red. And in some cases, maybe that's part of your strategy. It's not okay to be there, but it's part of your strategy. When I think about Amazon, the first, I don't remember if it was the first 8 or 10 years, they were in the red. Even Tesla, I just looked at Tesla's stock recently, and they were in the red for many years, but now they are turning a corner. But that doesn't have to be the norm, and nor should it be the expectation, right? Because it doesn't have to be that way. And I think that's what you're saying. But it does require a little bit of reprogramming, because there's some bad teaching out there for small business owners, especially.
Mm-hmm. Yes. And I think the same thing applies in investing. For example, I'm not interested in taking big risk in the stock market, but the idea of dollar cost averaging your way into the stock market month after month over decades of your life, it's basically a sure thing. It's a no-brainer. You will make money if you do that over time. If you don't make money, that means the earth basically shifted on its axis. We're dealing with an Armageddon situation. Nothing is what we thought it was, but if things remain fairly like they are on earth right now, that should be the case for you. So it's not risky to invest into the stock market over time in a consistent way. Have you heard that study from 1929 until very late? I think it was like 1954. If you invested money, it took all that time investing a lump sum right after the crash to get back to even, or right before the crash to get back to even. It took decades. But if you invested over the course of that time in a regular amount, you actually were profitable.
Yeah,
Have
the
you heard that
recovery.
study?
I've not seen that specific study, but I've looked at that before myself, because you're
Mm-hmm.
really, like you were saying, just for the listeners, you're looking at the dollar cost averaging. So yes, if you had put money in at the peak of before the Depression, you would have lost that money. But what you've done is dollar cost average it. So you buy at whether the market's high or low, you're buying. So some of your money you would lose on it, but the vast majority of it you would gain over time. And that's what you're saying, is that you bought at the bottom and you just continued to buy into it as it increased over time. And yeah, if you run the math, it's just astronomical when you look at the returns. I do like what you said, though, and I want to make sure the listeners heard that, is because there is a lot of fear about the market. Like, what if I put my money in and I lose it all? Well, for you to lose all your money, the United States government would basically have to go away. Like you said, like the economy, the global system, like everything would have to melt down. And if that happened, your money is the least of your worries, because you've got a lot of other things that you're going to be having to deal with. And everybody in America is going to be in the same boat with you. And so the problem is at a lot bigger scale than just a financial situation. At that point, you're dealing with a lot more issues.
Yes, and that is an issue you should think about. So, for example, I never would think to have all my money in the stock market. I would always have it spread out among multiple things. You were just talking about all the different kinds of chickens you have in the flock of chickens that you have. That's what your investment should look like. They should all look very, very different from each other.
Yeah, I love my chickens. We should have recorded that conversation for the audience. I'll say that. Yeah, and I was thinking about that because I was like, I'm not there yet because I'm just a new chicken farmer. But I was watching Mike Rowe's Dirty Jobs, and it was just interesting that, here I am. Now I'm a little bit of a chicken farmer, and we watched this show, and there's this farm, and they had, I think, 100,000 chickens or something like that they were, and it was their business model, and it was just amazing to watch that. But that's just another form of diversification. You having a small business is a financial diversification. I've gotten into buying gold and silver lately. Under most circumstances, buying gold and silver is not what you would call a great investment, but there's a lot of indicators right now that show that silver is way undervalued. Even President Trump in 2017, I believe, talked about how much of a shame it was that silver was priced as low as it was. I started buying silver last year at about $15 an ounce. This year, it's traded up at about $28 an ounce. And so when you look at that, that's a pretty good return on investment in 1 year. And it's still not hit its ceiling. It's got a long way to go. But, one of the topics we were going to talk about today was, how do you invest like a hedge fund manager? You've been doing that for a number of years, one of the only female hedge fund managers in the entire world, and been very successful at it. And so what is some of your best wisdom when you look at investing like a hedge fund manager?
I love that question. Thank you. When I started the hedge fund that actually had other investors' money in it, I was looking for consistent returns. Everyone thinks that hedge funds are risky because that's the way the mainstream press covers them. But the first thing I was looking for was an opportunity that generated a consistent return stream month after month after month. And when I found it, I identified that as an important opportunity, because when something is consistent, it allows you to leverage it. Prior to the housing crisis of 2008, for example, we used to feel that way about home prices. We always thought that home prices were consistent, and for that reason, we could put in 20% cash, borrow the rest, buy the home, and we would get the appreciation on the entire home price. And I was looking for exactly the same thing. I'm not interested in taking big risks with money. So when I found a strategy that generated a monthly return of between 1% and 3%, it seemed very, very safe to me to invest every penny I had in spare cash, plus $250,000 that I borrowed on credit cards at less than 2% interest. And when I did that, I put my money in the fund plus the borrowed money, and it kicked out a return. The first month, the second month, the third month, I was making money consistently. It was so consistent, it was boring. It was like watching paint dry. And then pretty soon, the partners, I was working at a boutique hedge fund consulting firm at the time down in the Virgin Islands. And my partners, who were sort of naysaying in the beginning, it's very difficult to launch a new fund right now. No one wants to buy into a new fund right now. They were looking over my shoulder. We would have these investment committee meetings regarding the various hedge funds that the partners in the firm were running or advising on. And I would say, yep, made money again, made money again. Oh, what do you know? I made money again. Pretty soon, all of those guys wanted to be in the fund with me because I was making money and then they were making money. So what were the lessons that I gleaned from that experience? I think I was 33 years old at the time. I was pretty young to be running a hedge fund, and most of my partners were in their 60s. And the lessons I gleaned from it are, when you know something is right, when you know that it feels solid, don't let people deter you from what you know and believe to know. Listen to what they have to say, but if you're convinced that they're wrong and you're right, proceed with your plan. And don't be afraid to leverage something that is safe to leverage. Why was I able to use that kind of leverage? For a few reasons. One is because I had a high income and a high earning potential. So this is a very important investing lesson. The more you invest in a high income, the ability to earn a lot of money in your day job, the more you can avail yourself of fantastic investment opportunities that other people might be afraid of. And the more you can lever into those opportunities so you get even more bang for your buck when you find one. We tend to think of leverage as a really scary thing, something you should never, ever do. But I sometimes hear Dave Ramsey ask somebody when they say, well, should I borrow on my house to invest in the stock market or to make another investment? Or should I, how does he say it?
That sounds pretty accurate.
Yeah. And he says, absolutely not. No. The question is, should I pay off my house with this money, or should I keep my mortgage and use this money to make an investment? And his answer is, well, if you wouldn't borrow on your house to make this investment, you should pay off your house. And whenever I hear that question, I always think, well, if it's a great investment, of course, borrow on your house. Why not? So thinking like a hedge fund manager requires you to do things a little bit differently in your brain with respect to your investments. If it's a consistently performing investment, don't be afraid to leverage it. If you have the income to cover a loss should one arise. I knew going into that, if I lose my money in this opportunity that I think is super consistent, I better have the income to pay it back. That's $250,000 I owed a Visa. And I did, so I was able to do it. Does that make sense?
Oh yeah. It's a whole adage of you're talking about risk. What you're saying is you really didn't have risk. You saw it as a very minimalized risk because you had already found the investment. It was predictable. You saw that. And that made you feel comfortable. And just for the people who don't follow numbers or don't hear numbers, I know there's a lot of people that math is kind of difficult, but you're talking about 2% interest on your credit card, which is what you had mentioned, but you were getting 1 to 3% per month in returns, which
right.
Cumulatively looks like, anywhere from 12 to 36%. Let's split it in the middle. It looks like 24% annual. So 2% that you're paying interest versus 24% that you're getting in new income or new wealth or growth. And that sounds like a pretty good trade to me.
Definitely a good trade. It was very nice.
Now, it does bring to mind a conversation I had with some people with some riskier investments. And this is something I wouldn't say would be a good thing to do. That we've all heard about cryptocurrency and how big that's been over the last, decade or so. But it's gotten more mainstream in the news probably in the last 2 or 3 years. But I knew quite a few people that were actually taking credit cards and, taking out, similarly to what you did, taking out lines of credit to finance their cryptocurrency investments. And, not necessarily a good thing, because there's a lot more volatility in the cryptocurrency market, and less stability, but also less backing. Like, you're not really investing in a company when you do that. And so that's a different way of using credit to leverage, but it's a whole lot more risky than doing what you did.
I tend to agree, but I'd like to make a little bit of a distinction. The instrument itself, cryptocurrency, a stock, a bond, a futures contract, an option, the instrument itself may have a certain amount of risk in it if you're just buying it, because the risk is how the price just fluctuates to the passive investor who's just holding it. But a lot of times there's also risk or diminished risk, increased risk or diminished risk based on the way you're using the instrument. So my fund, for example, traded S&P 500 futures contracts, and they're more established than cryptocurrencies, but they're generally considered to be extremely volatile, very risky instruments to play with. But the way we were using it didn't feel risky. It felt like an easy thing to do and very consistent. So when someone says they do S&P 500 futures or they do cryptocurrencies, the risk is mostly inherent in what you're doing with the thing. You can use a chainsaw to chop down a tree and build a bonfire in your backyard for your kids, or you can use it to chop off your leg if you don't know what you're doing with it. The danger isn't necessarily inherent in the instrument. Does that make sense?
Oh yeah, absolutely. And I love the word that you use, instrument, there, because I think that's not a word that you hear a lot in just personal finance circles. And so what you're saying there is, whatever you're investing in, whether that, if you're investing in Apple stock, that's your instrument. If you're investing in a mutual fund, that's your instrument. If you're buying a piece of real estate, like a house for a rental property or for flipping, that is your investment instrument. Um, and you're talking about the risk of the instrument versus the risk of where you're getting the money from.
I think what I'm talking about is maybe three things. One is the risk inherent in the instrument. If you buy a house, there's the risk that the housing market around you is going to decline. So that's a risk inherent in the instrument. And then there's the risk that comes from what you do with the instrument. If you rent your house to people who trash it, that's a risk associated with the skill of holding the instrument or not holding it well. And then I think there's a third risk: where did you get the money? So, but when you're worried about risk, I think it's good to divide and conquer. What is the specific risk you're worried about, and how do you manage for it?
Yeah, and I do love the way you put that, because there's an old adage. If you mentioned Dave Ramsey earlier, but Dave's a very anti-debt guy. I'm a very anti-debt guy, but there's a couple of times in my life where I wish I wasn't so anti-debt, and that is when I moved out of my first house into my second house, and I was so anti-debt that I just had to sell that first house. I wish I had kept that first house. I paid $62,500 for it. My note was $500 a month. That house is now worth over $300,000.
Mm-hmm.
And I could have easily paid that off, and kept that $500 a month house payment. That was not something that was high risk for me, but it was a mindset difference. And then when we moved into our second house, another, primary residence, and we left that house, I just sold it outright. It was already paid off. I should have turned it into a rental property. I should not have, unloaded it. The only reason I unloaded it is because I was carrying debt on my new house, and I just took all of that cash and applied it to paying off the new house. That's where I was at that time in my life. But looking back and learning and having a little bit more wisdom, I should have not been so hardcore, I think, in my financial mindset. I should have, really assessed, like you said, the risk and the instrument, and evaluated that. And my risk was really low. I was not going to lose a house that was already paid off. I could have just kept that. And that house is probably, I think I sold it for about $189,000. And that house is worth over $300,000 today. So, there's about close to $750,000 in real estate that should be in my portfolio, but is not because of my mindset towards debt.
And that's what happens when we attach moral meaning to something that is a neutral tool. Debt is simply an instrument. It's a tool, and what are you going to do with it? I have an aversion to consumer debt. I never carry it, but I have absolutely no problem with using debt to accomplish goals when it makes sense to do so, and it gets me where I want to go faster. It would be like saying, I don't ever use the turbocharged car if I want to go somewhere really fast because I'm just morally opposed. So I can see that people get themselves into trouble with debt, but it's not that debt is inherently evil. The reason they get into trouble with it is because they have a desire to spend more than they make. That's how you get into consumer debt. And debt isn't the issue. It's that desire that is the problem.
Oh, yeah, absolutely. And I think that's, I guess you could call it being mature enough to behave yourself when it comes to your money. There's a lot of people out there that don't use debt properly. And it's a dangerous tool. It can be a dangerous tool. Like you mentioned, you don't like consumer debt. We have actually, my wife and I, we got rid of all of our consumer debt and have not had any consumer debt since probably about January 2002. So about 18 years without any credit card or consumer debt, and then paid off our house in 2000, first time in 2007, second time in 2012. So we haven't even had any mortgage debt since 2012. I like it that way, but at the same time, and I haven't done this yet, but I am looking back over my financial decisions just to try to look at my key learnings and go, what would it look like mathematically? Because the math is, predictable. If I had not paid off my house, if I had kept, $250,000 in a series of investments over the last 8 years instead of, paying off my house, what would that look like? What would my financial portfolio look like now versus then? And it's not because I just want to feel bad about, the zeros that I've lost. But it's really more about going, okay, I have, I'm 50 years old. I have a good another, hopefully 25, 30 years of building wealth for my family and for generations to come. So I want to have key learnings from my past, like what I want to do differently with the next 30 years versus what I've done with the last 30 years. That's really what I'm after.
It's really interesting. And of course, it's not all just math, right? There's also Dave Ramsey talks about the mental clarity you get from not having a mortgage. And so you can manage your mind around having a mortgage and think it's just a tool. But there's also the idea that you feel more free without a mortgage. So there's a value to that too. I'm not discounting the value of that, certainly. Right? Do you see what I'm saying?
Oh, absolutely. As somebody who's had their house paid off for the last 8 years, I like not having a house payment. It's, when our house payment, when we paid off our last little bit, I think our house note was about $3,200, $3,200 a month. So that's, roughly $40,000 a year. Which is pretty significant when you think about it as a chunk of money. But at the same time, if you've got the income for it, it's not necessarily that psychological, but there is a psychological barrier that does shift for you, and you do look at your life a lot differently. So
one funny thing I wanted to mention based on what you said, Tony, is when you were talking about the maturity to use debt well, I don't think that I'm a particularly mature person. Here's how I use debt well. I think it is more fun to make money than it is to spend money. And that's why I don't have problems with consumer debt. I just view making money as a game. And that's where I find a great deal of amusement. And so it would never even occur to me to go spend money. That's not where the fun is.
I love the way you put it that way. Um, you know, it's interesting you say that because I think I've gone through phases in my life. I'm a gift giver. That's one of my 5 love languages. And so I like spending money on gifts for people, including myself. I like buying myself gifts. Um, but, you know, when I was younger and breaking free from, you know, the financial mistakes that my parents and, you know, our family had been making and trying to, you know, break free from that, I did get excited about the idea of, you know, what my investments were doing, and there is an excitement to that, and it is a mindset shift. It really is, because you shift from being focused on making money and spending money to adding this third component to it of watching your net worth grow or making investments, or, you know, it's a whole different mindset and value set that comes into your life that maybe you don't learn from your parents. You have to, you know, experience it before it actually takes place. And you do start looking at your life differently. You start looking at your money differently, and finding different priorities for your money.
So this is kind of funny. I'm not just a hedge fund manager myself. I'm a lawyer and a business mentor and advisor to other hedge fund managers. And one of the benefits of using leverage in an investment that you have a deep conviction is going to pay off is that every little expense becomes something that you know you could magnify dramatically, so you don't want to spend money anymore. For example, I worked with a high performing hedge fund manager. His returns were in the triple digits typically on an annual basis, 100% or more. And he wouldn't spend $5 on a cup of coffee because he knew that that $5 invested in his fund would be a fortune over time. And so to him, it wasn't a $5 cup of coffee, it was a $500 cup of coffee. And so there was no way he was going to waste money on something like that. When your investments perform really, really well, you really do not want to blow money on things that are inconsequential.
Yeah, I think that's a great way, and I like to call that the time value of money. Just understanding what you have today is not what you're really spending. You've got to extrapolate that out. Now, you talked about 100% returns each year. When I look at stuff, I kind of get it down to more the average consumer investment level of about 10%, because I want that to really be the bottom threshold. I like what you said about 100% returns, because sometimes people go, "Oh, you can't get 10% a year." Well, the world you run in, you're expecting a lot more than 10% a year. You know, you're in the 24% range. And for people that don't understand that, there's this thing called the rule of 72, which basically says whatever percentage return you get, you divide 72 by that number. And then that's the number of years it takes to double your money. So at 10% return, it takes roughly 7.2 years to double your money. At 24% returns a year, which is roughly what you were saying earlier, Kelly, with your investments, that's looking like about 2.5 years roughly, that you're going to be able to double your money every 2.5 years. And for the gentleman that was 100%, he's doubling his money every year. And that starts to produce some astronomical results. So when you start adding those percentages up.
I have a client, and the way this particular client is regulated, he is required to report when people get in and when people get out, what their percentage return is. And one of his investors got in and got out and earned over 9,000% over time. So it's just funny. Yeah, the returns do get astronomical to the point where you look at them and think, can this be right? But it is. And of course, that's not to say that definitely do not want to imply that these investments always pay off. They don't always pay off, which is a reason that you have to be very, very careful and smart about selecting them. And that's where many people go awry and they lose a great deal of money. So it's something to be very careful with.
Yeah, I think there are no guarantees in the financial world, and I think that's the one thing you've got to be aware of that helps you. I guess the healthy amount of fear, if you want to say, because you don't want to get too bold. You always want to realize that there is an opportunity for loss, but you can minimize that opportunity. So let's go down the road just for a minute. Because a lot of people, your financial advisors out there are hundreds of thousands of financial advisors out in the marketplace trying to sell you mutual funds or some kind of type of investment. And the reality is most of these guys don't really know what they're doing. They get trained on a specific system. It's usually to sell a mutual fund so that they can take your money, put it into a big portfolio, collect 1% to 2% fees on you per year. Regardless of whether or not you make money, they're going to collect their fee. And that's kind of the way the business model is set up. You may, it's sad, but I've looked at some people's where they're invested in funds that are getting like 3 to 5% returns, and then they're getting charged 1% to 2% of their value. And even if you lose money 1 year, like the fund's down, they're still going to charge you 1% to 2%. But here you are, hedge fund manager extraordinaire, and you're talking about returns of like 24%, 100%. Like those are just numbers that most people would just say they're not even real. They're not legit. So help convince the audience like that those kind of things are real and they can be achieved. And even if it's not 24% or 100%, it's better than the 10% that some people might be used to.
Oh, I love that you use the word convince, because when returns are real, chances are good, not good. Chances are almost 100% that the person who is experiencing those returns or creating those returns is trying to convince you of nothing. They don't need your money. So when someone's trying to convince you that the returns are real, they're probably selling you something that isn't real. For example, when I created my fund, the opportunity that I went looking for was a person, a skilled trader of financial instruments who could generate returns like that in his own account. And when I found that person, my next job was to convince him to take money from me. He didn't need my money. He didn't want my money. The only reason he eventually decided to trade my money and the money of my investors that came into the fund with me is because he thought it would be fun to try his hand at trading other people's money. So if someone is convincing you and selling you hard to put your money into something, chances are good they are not that highly skilled person that you really want to invest with. That highly skilled person doesn't need your money. Does that make sense?
Oh, absolutely. And I think that's the salesman mentality. If they're trying to sell you, then they probably maybe aren't the best at what they're doing. Whereas if they could care less if you're going to give them their money, they're going to go be successful regardless of what you do with them. And I think that's kind of what you're saying is if you're not that interested, they're not going to work that hard trying to sell you because they don't need to sell you. They're just going to go be successful the way they're successful. That's very much an interesting way to look at it. Whereas if you get to a financial advisor who's just following a model that they've been taught or trained on to get your money and stick it in a growth stock mutual fund or even a growth international fund or just any of those funds, they're actually trying to sell you something, and it's because they make money when you transfer funds to them. When you do a Roth rollover, an IRA rollover, and they're taking 5% off the top just for you rolling money to them and giving them the opportunity to manage your money, which they're not managing. They're not doing anything with it in most cases. You're just paying for them to hold your account. You're not paying them for providing any real value to you in most cases. That's a very interesting way to look at it. And, you're the first hedge fund manager. Actually, that's not 100% true. I've actually met 3 now. But you're the first one I've actually had a really in-depth conversation with on this. So it's very enlightening to me.
Thank you. Well, I'm happy to be here, Tony. It's a lot of fun to talk to you.
Yeah. So we're going to wrap the show up, but I really want you to leave this group, this audience, the goal of us doing this show today was really to invest like a hedge fund manager, how to get high level returns. What would be the 1 or 2 tips that you would leave with someone that would just stick with them as we wrap up the show today?
The most important thing I can tell everyone who's listening is invest where you are going to get the highest return. And it is almost always the case that if you invest a little bit of money in coaching to eliminate the cancer of under-earning from your own professional or entrepreneurial life, you will experience a 4 times to 10 times return on your investment, return on your income in the first year. Clients I work with are generally women who are under-earning in their businesses, and for a little bit of money invested in coaching, they can quadruple what they're making in their business. So that is the first place you should look, is at your own under-earning. And when you do that, then the world opens up to you, and all of these interesting, lucrative investments that can change your life become far more available to you. So I think that's probably the most important thing I could tell every listener. Get your own income as high as you possibly can, and then the investing world just busts open and you can start having so much fun with what you're doing in your portfolio.
Yeah, I think that's great advice. When I think about my path, that's definitely where I think I've gotten the most return. I grew up in a lower income, not lower, but, low middle income family. Got out of college. My first year out of college, I was making about $12,000 more than my mom. Actually, that's not true. $5,000 more than my mom the first year. And that continued to grow. My income grew while hers pretty much stayed the same. And so I thought I was doing really well. But because of where I grew up, I did not understand this concept of a 6-figure income. Like, the concept of making $100,000 a year was not in my vocabulary. It wasn't in my mind. It just wasn't. But what I did understand was how to improve myself and to continue to learn and grow. And so because I invested in myself and, reading books, learning everything I could about specific topics, I was able to see my income continue to grow, especially when I invested in myself in the areas of leadership and business and skills, like really developed professional skills, and saw that grow. So I totally agree with you that's probably the number one place you ought to focus, is how to increase your income and set specific targets and goals around that. So Kelly, thanks for being on the show. Thanks for talking to us. As always, just a wealth of wisdom. How are people going to get in touch with you and draw more information from you and learn and kind of increase their income, boost their income? I wish that everybody that heard this podcast would be able to hit that 7-figure income, which I know is your goal for them.
Absolutely. Please listen to my podcast, How to Make More Money. It's a podcast that teaches you the 7 skills that take your income to 7 figures and beyond. These are the skills I've used in every business I've ever been successful in. They're the skills that I use with my hedge fund manager clients, and they're applicable to you and what you're doing, whatever your business is. So it's called How to Make More Money, and it will help you take your income where you want it to go so you can invest in all these fun things in your portfolio.
Well, thanks, Kelly, and have a wonderful day.
Thank you so much, Tony.
The Millionaire Choice Show shares the opinions and experiences of people and should not be considered financial advice. Before making your own financial choices, please seek out a registered financial advisor or certified financial planner.